Folks, welcome to this conversation about Northern Nevada credit unions and the economic forecast for 2023. My name is Rob Eyler. I'm a contract economist with the California and Nevada Credit Union Leagues, and I'm also a professor of economics at Sonoma State University. I'm here today with three credit union leaders in Northern Nevada, and I'm going to have them introduce themselves before we jump into kind of some high-level ideas about the forecast and a conversation about where things might be going. Jennifer, please.
I'm Jennifer Denoo. I'm the president and CEO of Great Basin Federal Credit Union, and we're located in Northern Nevada and now can serve part of Treasure Valley, Idaho.
Thank you.
I'm Tom Wambaugh. I'm the vice president of member services at Greater Nevada Credit Union, and you'll find our branches all over Northern Nevada, but we have some subsidiaries that have presences actually across the country.
Hello, everyone. My name is Todd Sorenson. I'm the president and CEO of Elko Federal Credit Union in Elko, Nevada. Our branches and footprint are primarily northeastern Nevada.
Thanks, folks. And thanks again for taking the time to have this conversation. What I want to do real quick is I want to share my screen and kind of provide some thoughts about, as an economist, where I see things going, but also talk about the recent forecast that took place for Northern Nevada. One of the things I pulled out of the forecast was the rising probability of a recession. Now, economists are pretty split, and you can kind of see that it's about 61% about where we're going. But in your mind, the idea is that we've had relatively high interest rates versus 12 months ago. And that increase in interest rates has got to have some detriment in terms of the cost of doing business and how consumers look at spending in the future. And we still have relatively high lingering inflation, which I'll talk about in just a minute. And you can see that basically almost on the same path as inflation, we've seen this rising probability of recession. And that was one of the big points of the forecast that I read, is that at the end of the day, we know the conditions are there for a rising probability of recession. Whether we get one or not is unknown. This is the path of recovery in the Reno MSA as one indicator of Northern Nevada. It's not the total indicator, but it's one way of thinking about where the population center is and what's happened. Reno is actually stuck out in terms of the Western United States as one of the major metro areas that recovered the fastest, and really in ways that economic development wants to see. So you can see, moving left to right, total jobs are up about 4% from the pre-pandemic benchmark of January 2020 as of the end of December 2022. So basically the end of last year. But in manufacturing and construction, jobs are way up seasonally adjusted. And that really talks about the economic activity that has sprung up in Reno over the last 30 months. You can see that other industries have basically recovered, or at least getting closer. There's a couple that are still languishing a little bit, but that leisure and hospitality number, especially for a place that is historically driven by visitors and kind of the environs of people flowing through the state, we're looking at that both in California and Nevada as a league about whether or not members are exposed to risk the longer and longer those jobs don't come back. But this really tells a tale of how well Reno as an MSA or as a metro area has recovered since the pandemic, mainly in construction and manufacturing. The forecast also provided this graph, which was kind of an overview of what's happened and where the growth has taken place, and is almost like a key performance indicator chart where it has green arrows suggesting that the increase is good for Northern Nevada, the red not. Now, unemployment has barely crept up. So one little caveat about these data is while there's a red arrow for unemployment rate and all these other ones are looking really good in terms of a year-on-year growth, in terms of year-on-year growth data, the unemployment rate moving from 2.6% to 3.5 is not that big of a deal historically. It's up, but some of that could be the reemergence of labor force that left for COVID reasons and is now reemerging in Northern Nevada to provide a larger workforce. But that's still very, very warm to hot labor market conditions. One of the biggest things for credit unions, and also think about how our members are thinking about their own consumption, is what's happening with personal savings. So we've seen personal savings go all over the place, but a lot of economists are pointing to this because of two items. One, we had this rocket ship up as people were receiving funds and putting money in deposits. And in many ways, this kind of mirrors not purely the way deposits have gone, but kind of the evolution of deposits and trend. You can see that 33% was kind of the height as a lot of money came in from federal and state sources. That flowed out. There was another tranche. You could see that other peak happened on the other side of the 33.8, and it's been declining ever since. So the decline generally is due to two things. It's one, you got money and now you spend it, but because of inflation, you're spending more than you expected. So the dollar amount you're saving is falling, as well as your income's not rising as fast, which means your percentage you're saving is starting to slip. And the 2.4 is down at relatively historic levels in the sense it's hard to go back even like 30 or 40 years and see personal savings rates that low or lower. The way to read that is if I give you $1 more, how much are you saving of it? So that's how far that's gone down. This is the big question of the day. What's going to happen with inflation? This slide actually comes right out of the Federal Reserve's book that they use to decide on interest rates in terms of the Federal Open Market Committee's deliberations about what to do next. And we're going to see that those deliberations this week lead to another interest rate increase. The magnitude of that's an open question. We'll probably talk about that in a little while. Those red dots are the forecast for inflation. 4.4% says that in December 2022, the things we buy at home after food and energy increased 4.4% as a total amount of spending in terms of the cost of that basket of goods from 1 year ago. So that's down from recent peaks. And the supposition is that inflation is going to move through those red dots toward 2025 and beyond. That blue dotted line is what the Federal Reserve really wants to do, is sort of cement where that blue dotted line is, which is inflation expectations at 2%. The longer inflation lingers above that blue dotted line, the more expectations want to rise in terms of that anchoring. And the Federal Reserve wants to make sure that that anchor stays at 2%. So we know those interest rate cuts have to lead to some instability. Housing markets are going to have to give back some of the gains. Job losses generally are coming to the United States. We've already heard about this in tech. How much that reverberates into construction, retail, transportation, and logistics, which may have overhired in terms of the cyclic aspects of hiring when things are really good and still having those folks around. And if we start to cut back, will you see Amazon jobs, not central Amazon, but actually Amazon jobs at distribution centers start to slip back a little bit? Well, I'm sorry. That's really, at the end of the day, the biggest issue with inflation. The longer it lingers and the more interest rates have to creep up to cure that problem and kind of force that blue solid line through those red dots, the trickier things are going to be. So in essence, that's an economist view of what we've seen in the forecast. There's more resources at the league on E-Train. If you go to ccul.org, you can find E-Train there. Please check that out. There's a ton of good resources there. But what I want to do now is I want to go to our panelists and talk more about where they're seeing things happen, or where they're seeing things with their credit unions. And the first question I have is, how did the forecast for Northern Nevada make you think about the assumptions your credit union is making looking forward 1 year? And what are your thoughts? So Jennifer, we'll start with you.
Sure. Well, I mean, first off, I just want to say that I was attending, really proud of being a Northern Nevadan, and just the work that Northern Nevada has done to set us up geographically, in our area for success, as you were mentioning, expanding the dependency on so many different types of businesses. So I was proud of that work, and I believe it. I know that they were, honest with their findings, and but I think it's optimistic also. So one thing that I thought was interesting, they were really talking about the housing market and how, certainly we don't think it's going to take a crash at the credit union. I don't know that we think that either. I think certainly it's going to stabilize. How that impacts our credit union, if members aren't selling or refinancing, they're kind of hanging on and hanging tight. It certainly impacts how we, ALM and cash flows and how that might change things. So that really was not, it was a pleasant surprise, I suppose, to kind of hear about that. That was kind of surprising to me. And, I'll let the others talk, because I'm sure we'll talk about some of the other things that stood out, but that was something pleasant. For unemployment, we are certainly watching our delinquency numbers because that's going to be that leading indicator, and we are seeing delinquencies rise, but they were so low in the first place. So I think, first payment defaults and that sort of a thing. But I'll let the other guys, pitch in here and see where that goes.
Perfect. Thank you so much. Tom.
Yeah, Jennifer, ditto. As we go through what we saw from EDON and the numbers they presented, it was pretty interesting to see some global and national figures and kind of bring them home a little bit and see how those things are applying. I think you nailed a couple of things that we're looking at and how we think it's going to affect both Greater Nevada Credit Union, but also our members. The upward pressure on wages, the unemployment that we see, all of these things gathered together with that inflation number that doesn't seem to be slowing down enough yet we've got some folks that are feeling the pressure on their budgets. And so, yeah, our delinquency ratios have been so low for so long. It's kind of a dream Cinderella state almost, where you're looking like, wow, this is great. Nothing bad can ever happen. Delinquencies are so good. And yet we've seen them start to tick up. Now, they're nothing like what we've seen in previous economic tough times, recessions and such. But you're starting to see those numbers start to rise for the first time in a long time. And that's really indicative that our members are going to need our help more than ever right now to kind of weather through some of these challenges that they've got. You know, whether it's just budgeting, learning more about budgeting, learning more about saving, some things that we always want to do, but they're going to need that help even more now than probably ever.
Yeah,
that's a great point. Yeah, I mean, I think, and as somebody who's a board member of a credit union, one of the things I try to be very vocal about in board meetings is that, folks, we have been on such a great run as an industry or as a business that, you know, when delinquencies creep up, don't start to freak out that they creeped up a little bit, because they kind of should. But the second is that, like Jennifer said, and Tom, you kind of corroborated, is that this is still a historically amazing time period in terms of delinquencies with respect to how credit unions operate. So it's that the board education sometimes, especially in the CEO's chair, is a big deal in terms of not having, you know, board members freak out because there's this little tick up, thinking more about the long history. And in fact, I've asked our finance people to put a little bit more history in there to really give board members a perspective. So Todd, what I want to do is I want to ask you the same question. I also want to ask you a second question, because you're a part in a unique space in Nevada, in the sense that the greater Reno area has sort of this smaller effect on you in Eastern Nevada. So you know, talk about where you think the forecast may affect the way you think about credit unions, and specifically yours, the next year, but also what's something unique about what's going on in Elko and kind of Eastern Nevada that you think what the forecast told you might affect the way you think about strategy, and maybe the things you consider, you're concerned at night or not concerned because you saw some good things.
Yeah, the thing that's beneficial when we get to, whether that be targeted economic data or what have you, when people think of Nevada generically, they think of either Las Vegas or Reno, right? And certainly at Elko Federal Credit Union, our dynamic out here is a little bit different. I would say that Reno might lag behind Vegas a fair amount in certain aspects, and Elko would lag behind the whether that be some of the demographics or some of the leading indicators that Jennifer mentioned in Reno. We would be slightly behind that, but maybe not as quite a wide a pendulum, because our pendulum really is based 100% and 1000% if possible on the price of gold. So our economy is so heavily weighted into that mining industry that some of these other, whether they be beneficial or potentially not such great news in the form of an economic indicator, we're slightly insulated from at times, right? But then as that price of gold will vary, we would be in stretched terms or stretched margins at other peaks or valleys that Reno or Las Vegas wouldn't necessarily experience. So I think from a housing perspective, I think Jennifer had a really good point, and Tom as well. From even a delinquency standpoint, is what are our members here in Northeastern Nevada experiencing? I think that we certainly had part of that price appreciation in home values. That's going to be a stretch to some of our income margins for some of our miners and some of those positions that are predominantly held out here. I think from an inflation perspective, that's a big worry, right? I mean, I think that whether that's managing a credit union balance sheet from inflationary pressure or trying to protect our members from some of its prowess and power, I think that is something that certainly is a big impact on us. We have a unique way of banking these days that we almost compete with everybody for shares or deposits, right? But our lending market is maybe a little bit tighter from a geography perspective. So I think that's probably the thing, as I lateral to your second part of your question, Robert, is to say, what am I potentially concerned about? I think that from a management of a balance sheet, I certainly think that liquidity is going to be something we have to look at. We're all going to be fighting for for the same dollar. And to your point in the graphs and information that you showed earlier, it's going to be a smaller piece of the pie that our members are not willing to share, that they're able to keep in and keep as a, whether that's a savings rate or eat into their existing savings. I think that's something that we're really going to have to watch.
Yeah, and if you think about history, one of the things about, and I'd love to have you also talk about how inflation affects the gold market and how maybe this period has been kind of different positively in some ways too, where you're kind of in this offset, right? When people look at inflation as a gold hedge, or I'm sorry, gold as an inflation hedge, but then also think about the industrial use of gold. There's no doubt about the fact that one of the biggest issues right now is the erosion of deposits and how much longer it's going to linger. But the longer this goes on, I mean, we're not talking about a 6 or 8 month burst of inflation that is for some, natural disaster or some real quick geopolitical issue. I mean, this is a lingering supply chain and demand side problem that's just now starting to get cured. So how much longer will the deposit erosion and kind of people, like I said, members thinking about the way that they consume and save, how that's going to affect the lending machines that we have at credit unions, on top of the fact lending demand should also be kind of contracting a little bit based on the way housing prices are and the way members are thinking about the next move.
In a completely opposite way, we've had in the last 6 months of 2022 some record lending months for Elko FCU, which is just, it's kind of the inverse, right? It's kind of crazy to think that that's what's happening, but I think that some of those supply chains, whether that be for some of our consumer products such as autos that are finally getting here, or what have you, as they're waiting. We're not in a larger metro area that you're maybe have the ability to work on multiple dealers' fleet orders. We have one of each out here. So, but yeah, record lending on that end, which is again a little bit of a head scratcher at times. And I'm a little bit new to the market up here, but in that regard, it's a nice problem to have to this point. But I don't think that we rest on our laurels at all on, again, that balance sheet management for some of these liquidity or share interest rate components of it.
Thanks, Todd. Tom and Jennifer, could you talk about the uniqueness of your credit union? What might help you kind of say, wow, okay, I know that there's some headwinds out there, but I think we're in pretty good shape, and here's why.
Mm-hmm. Well, for our credit union, one thing, I was, here also during the recession, and there are things that are different and there are things that are similar. I guess I feel grateful that I was here and could kind of see how some of those things impacted. And one thing that, we really pulled back during the recession in lending, and, everything just it felt like it got shut down. And, what would have happened if we would have just kept going, you know what I mean, and weathering the storm and continue to lend, because at that time, that's when the members also need us the most. And I think that members are kind of in a state of shock right now too, with rates going up. They've been so low for so long. I was, talking to a coworker the other day, and if you're age 30-ish or below, you don't even know a time of a mortgage rate, being greater than 3 or 4%. You don't know that a car loan, goes into the 4, 5, 6, or 7, etc. And so there's this level of shock. And really, even though rates are higher than they were, they're still pretty good. And so, Tom mentioned just education. And so education for our team, for our staff, and for our members, that just because rates have increased and you're feeling the pinch in certain places, it's time to really look at budgets and buckle down. But home ownership is still possible. Car ownership is still possible. And you just might not be able to have all of the other things, setting those priorities straight. And so really it's an education, because a good chunk of younger membership don't know. They have no idea what it's like to go through and have hard times finding a job, qualifying for the housing and such. So just, a thought of what we might be able to do, and, keep going strong, because learning from the past, we have to keep being available for the members, and we can't completely shut down like we did, so many of us did before. And so how do we do that? Pricing is going to drive it. And for credit unions, I think credit unions struggle with that because we are known for great pricing on loans, and we've had to do low loan pricing for so long. The poor members that were savers really haven't had much for, for several years. So it can be done, and even taking some losses, like you mentioned, we talk a lot with our board too. What is our risk appetite? And we are okay taking some risk and having some losses if appropriately, funded and priced. And so it's okay just have those, to have those conversations, because now of all times, we don't want to turn our back on our members in our community.
And you don't want to lose culture as a result of a cyclic swing, right? I mean, you want to stay, we're still here for the member, and, even though it's gone, we're going to want to work with you regardless of the situation, because we still feel like we're the best product in town. Tom, what's unique about y'all that might help you kind of, say we're going to weather this okay, or there's something that you're seeing in the forecast that made you feel actually okay?
Well, I think it's interesting. I think everybody on this call today has probably been through tough times, recessions. And it's kind of interesting as we've tried to apply lessons to a previous recession that was kind of a sharp, it changed finance of the Great Nevada Credit Union very quickly, very, very sharply. This one is kind of like a slow moving train. Will it, won't it? We think there's a recession on the horizon. Some of the skills that we had to learn to try to come out of the last one may or may not work and may or may not be applicable this time. And so I think some of the monetary policies that individual institutions might take on and balance sheet management, they're really important. And we've got to do those kinds of things to stay solvent and to stay there for our members. That's a pretty important mission for all of us. But I think the most important thing that we're trying to focus on is what are the stories about how our individual members are feeling with all these economic indicators? We're kind of the link between people hearing something on the news that they may or may not fully understand and their personal pocketbooks. And what are the ways that we can make those things make sense and help them kind of maneuver through those things? I loved Todd's comments about, hey, we're different in Elko. All this stuff that you guys are worried about, we're worried about different stuff. And I think that's so key to us kind of fulfilling what we're supposed to be doing in the credit union industry and movement of trying to make those things real to our specific members. So, we love to focus a lot on education. We love to focus a lot on those things that will help individual members through these tough times. One of the things that we've been doing, and I know you kind of asked a question about how is the credit union going to do well through these times, but I'd love to answer a question a little bit about how members can do well through some of these times. And I think that comes more to focus in on a little less on pricing, which is something we all kind of go to. And a lot of people will look at it and say, oh, 4%, that's a cool number. Maybe it's a great loan rate, maybe it's a great deposit rate, but they'll focus in on rate. We'd like to focus a little bit more on teaching the skills necessary. We invented a very gimmicky product a few years ago called I Can Save. It had a ridiculous interest rate on it of 5%. Back when we were paying, 5 basis points on savings accounts, but you could only get that rate up to $1,000. And the only way you got that rate was by making a deposit every single month. Doesn't matter how much the deposit is. Can be a nickel, can be a buck, can be $50, can be $20 direct deposit out of your paycheck. But the idea was to gimmick our way into teaching people how to save. And so as I think about how we're going to add a lot of value to folks as they come through this recession, whether it materializes strongly, has a big hard landing, has a soft landing, any of those kinds of things, is if we can teach people the life skills necessary to maneuver through these things, whether it's learning a little bit better how to save. Maybe they can't save as much because there's pressure with inflationary items on that paycheck. So maybe they can't put as much aside, but if they can learn the discipline of doing it regularly, that's a good thing. Maybe they can't afford as much a car as they might have 5 years ago, but if they can learn how to budget appropriately so they know how much car they can afford and maybe not get upside down so faster, not have to worry about the payment as much. These are all the ways that we can kind of come through as heroes for our folks that we kind of need to be. So I appreciate the questions a lot about what we're going to do rate-wise and those kinds of things to help the credit union itself get through. I think we're okay. We've had to do some balance sheet monitoring, manipulation, had to get some funding from places we haven't had to in a number of years, but I think we're going to do just fine with the sources that are available to us. For us, it's more about how do we take those resources we've gained and the knowledge we've gained through the last recession and others experiences to really benefit those individual members. Like none of us are B of A or US or Wells, where we've got 1 billion customers. We've all got individual members, some of us a little more, some of us a little fewer, but it's those individual life stories that I think are the big, how we're going to help our members through whatever comes.
Yeah, and I think one of the weird ironies of this cycle is that we took the lessons we learned in the Great Recession, we immediately applied it to the borrower in, like, let's say April 2020 to December 2020. Then as the cycle kind of flattened back out and we kind of started to recover, we peeled away from that. And now we're going back into what you could say is like classic economic slowdown mode, where we kind of can see that we're getting to the edge of the falls. We don't know how deep it's going to be, but we're starting to see some of the things that we can easily react to rather than having to force react, like we've had the last two sort of big contractions. But I feel like that when I look at the industry and I think about what the credit union board I'm on and the things I see from a data standpoint, it seems like the industry's so much better prepared for whatever is coming, that it isn't this huge tumult that's going to come to the industry. It's really just more shaping how members are able to kind of see their way through what's coming and educate them that it'll be okay. Which of course is kind of the heart and or almost meat and potatoes of what credit unions are trying to do. Why don't we just open it up in terms of how your strategy may or may not be changing? So, the thing that's so weird about the forecast is that inflation is this weird specter where I know it's happening and my wages are going up. So one of the things, for example, I talk about is that even if inflation gets cured, one of the things that economists are concerned about are the lingering high wage levels and how our smaller businesses are maybe affected by that, and what that may mean for member business lending, what it might mean for jobs not only created but also stabilized in certain areas of California, Nevada. I don't know if you guys have any thoughts about what you're seeing in terms of how you have member business lending and how that may or may not be working well, given the cost shocks that they've faced, or what members are kind of coming in and talking about as their number one issue, and how that might change your strategy.
Jennifer and I get to play in some of the same playground. I don't know if this is similar for Todd and the great folks out in Elko specifically, but I know it's not a strange sight to still see a sign on a building, a local business that says closed or reduced hours, and they list right out there, can't find help. And so those pressures on wages and just the unemployment rate being so low, there's folks that can't find the employees to keep their businesses going. And so, that's an interesting dynamic that's happening right now, and, doing whatever you can to help folks out, but it's just kind of a reality of it sometimes. And it feels like through the pandemic, we've kind of settled into that, where consumers are okay with the business being open a fewer hours, maybe not all the same service offerings they had. And it's tough to say this might be the new normal, but it might be this way for a little while until some of the equilibrium comes back, if it does, to where we can come back and expect some of those things, especially in a 24-hour town like Reno.
Yeah.
And of course, we've got branches and we serve members all over Northern Nevada, not just in Reno. But when you get those casino towns where people used to be able to go 11 o'clock at night to wherever they want to grab a milkshake or whatever, and we got businesses, sorry, we closed at 8 because we don't have anybody that can work past that. So Todd, I don't know if you guys see some of the same employment concerns out where you're at. The mines make such a big difference as far as wages and employment generally goes, but it's something that you see here, Robert.
Sure.
I think that just to that point, I mean, when I've been in Elko about a year, and in this position a little less than that. And when I first got here, I saw a little bit more than that than what we do now. It feels like they're trying to get right sized a little bit. But yeah, it wasn't unique to call and try to check hours on a local small business, and they would say, we've cut back hours to Tuesday, Thursday, and maybe Saturday, depending on if people can work. And to your point, Tom, about having that be okay, right? It's like on customer side, is that going to make sense? But we've all gotten a little bit used to that. But I do think as it relates to on the employment side and things that we can do, we had a meeting this morning internally to talk about, where we'd like to see, Elko Fed head as it relates to serving our members. And part of that is going to be, we have a fledgling member business loan program, Robert, to your point about, what are we going to see in that aspect. But so in terms of that, we'd like to see some of that build to help some of our small businesses. I think that we need to educate ourselves and our team on what's out there as it relates to, assistance. Like I was at a meeting last week talking about home ownership and how the benefit of home ownership in our communities and what its impact has on a base workforce population. And the benefits that brings, right? And so one of it is to educate ourselves on what we can do as it relates to resources, as it relates to home ownership. And not all of that is tied to what does our member make. It's what kind of programs can we help our member get into, or at least make them aware of, so that we can help them succeed, knowing that that's going to broaden our workforce base and provide a little stability in our rural communities out here. And that part I'm pretty excited about, actually. I think that as we're able to educate ourselves and pass that on to our members, I think it's going to be a real benefit.
Yeah, absolutely. And a lot of rural parts of California and other parts of Nevada have the same dynamic, right? That you have relatively small communities that, kind of depend on this financial institution to really provide that stability for them and products that will keep them rooted. And your local employers want that too, because the last thing you want in a relatively small place is labor market dynamics that you stop controlling, and then you making that hunt for workers even trickier.
Right.
And some parts of rural California are going through the same dynamic right now, which is very hard to advise what to do next in those scenarios. Jennifer, what do you think?
Just talking about this, I'd say one of the things that keeps me up at night, I'm a human resources, person. And I think about my own staff. One of the things they talked about at EDON was that an average 1-bedroom, 1-bathroom apartment in Reno right now, to qualify, you need to make $60,000 a year. Well, I can tell you that my average teller does not make $60,000 a year. And so, initially it stabbed me in the heart just thinking my employees, that represents some of my employees. It's not just my son and my daughter who, are out on their own. It's my staff. And how am I contributing to that? Or how can I help, not contribute to that? Another statistic they said was that the homeless population, 1/3 of the homeless in Reno are working. And I thought that also just really got to me. So when I think about, wages and even the credit union being able to attract and maintain those and retain those employees, sometimes it's not a matter of being happy. They could love the industry, love their job, love their coworkers. But when you have to make $60,000 a year to qualify for a 1-bedroom, 1-bath apartment, that changes things, right? And so how do we compete in a world that we used to be able to talk about, the culture and a career and all of those things? And that's just not the reality for so many people. So, it's really heavily on our minds too. And, work-life balance, wages, how can we be competitive, but still stay afloat ourselves?
Mm-hmm.
Sometimes the staff doesn't understand either that, like, hey, inflation's this, what's my raise? And although I think most of us probably gave higher raises than normal last year, or even some additional bonuses, that's not sustainable either. But that's their real life. And so what other benefits? Is there other ways that we can adjust, certain things? And, so we've been talking a lot about that, about, what prevents people from applying for a job? What are some of the struggles that our own staff is having just to survive, let alone thrive? And so I think we have to be very aware of that, as most industries do. But I, of course, have a heart for credit unions and attracting and retaining those quality, people that have, a passion for serving people. And so that's a struggle and something that keeps me up at night more than the numbers, do. Because I agree with Tom. I think we're going to be okay from that numbers perspective, but sustainability for the long run to continue to have our culture. It's all about the people and making sure that everybody is good and healthy. We have a quarterly meeting, and our last quarterly meeting, I actually had a therapist join. That was the subject of the meeting, is talking about mental health, because, you hear buzzes or you see little buzzes, of staff. And I mean, it was I mean, there was lots of tears, you know, because I think it just spoke to them, you know, anxiety and stress and things. And so we made that let's talk about it, and what resources are available for that. So it's not just, it's a whole circle that we have to help our employees with. So.
No, absolutely. And that's a really good point. And we're going to end on that, because I think one of the things that we see a lot of businesses looking at on the culture side is that we think about who we serve, but we don't think about our employees and bringing those basic needs to the table and trying to keep them stable, because the only way we're going to provide stable services is if our employee base thinks, you know, that they're in a good spot too. The thing about Reno and Vegas in specific is the percentage change on the rental cost in those two cities were higher than any other place in the West Coast or in the Western United States. If you include Idaho, Arizona, and the 3 coastal states, it just went up, and wages did not even get close to keeping up. So that story about the homeless is not shocking in terms of the data. It's shocking in terms of the reality on the ground. And that's where credit unions really make the difference in helping people out. Well, folks, thank you so much for your time. This is great. I think that gave a real good perspective about how y'all are seeing it as leaders in Northern Nevada, and how you're seeing that forecast. So really appreciate it. And thank you again from the league.
Thanks, guys.
Pleasure.
You bet. Take care.
Bye.
Bye-bye.